Okay, let's just dive right in. The decision to buy a home, it feels absolutely huge, doesn't it? It's more than just a financial choice. It's like this cultural milestone you're supposed to hit. But with the way the market is today, that pressure can feel less like a gentle nudge and more like a shove off a cliff. In this quote right here from a Reddit user, it just cuts through all the noise. It gets right to the heart of what so many of us are feeling. Are we being pushed into a bad decision? Is there, another way to even think about this whole thing? You know, the single biggest argument you always hear is that renting is just throwing money away. It's this powerful, guilt-trippy little phrase. But what if that's not really the whole picture? Let's peel back the layers and see where your money really goes when you own a home. This is the light bulb moment. Homeownership has its own set of hidden costs, we call them unrecoverable costs, that build exactly zero equity. So yeah, you're still throwing money away. It's just going to different places. It's money that, once it's spent, is gone for good. So check this out. For a renter, your payment is one simple number. Done. But for a homeowner, oh no, that payment gets chopped up into all these different pieces. And here's the real kicker. In the first few years of your mortgage, that little slice for principal, the only part that actually builds your wealth, is tiny. It's just a sliver compared to everything else. Let's break down these unrecoverable costs, and we'll use a pretty typical $480,000 home as our example. First up, property taxes. We're talking over $400 a month that builds, you guessed it, zero equity. You're basically just renting the land your house sits on from the government. Next, we've got maintenance. The 1% rule is a good rule of thumb, and that's another $400 a month. And let's be clear, this isn't for fun stuff like a new kitchen backsplash. Nope. This is for when the water heater explodes, the roof springs a leak, or the air conditioning decides to die in the middle of July. You're not investing, you're just trying to stop your house from falling down around you. Okay, now this one is huge, and almost nobody talks about it. Opportunity cost. That down payment of yours, let's say it's 48 grand, it's not actually doing anything for you and it's just sitting in your house as equity. If that same money were invested in, say, the stock market, it could be growing. That lost growth is a very real unrecoverable cost. And now for the absolute giant in the room, mortgage interest. In just the first year of your loan, a staggering $2,176 a month goes straight into the bank's pocket. This isn't building your wealth, it's building theirs. You are, quite literally, renting money. So let's add it all up. For this example home, the total unrecoverable cost, the money you're throwing away, is $3,248 every single month. This number is your break-even point. If you can find a similar place to rent for less than this, well, the math says renting is actually the smarter financial move. Okay, so that's the big idea, but now let's make this really useful. Let's turn this insight into a super simple tool you can use for any house, in any market, to figure this out for yourself. Let me introduce you to the 8.1% rule. Think of this as your secret weapon, your shortcut. It's based on 2026 forecasts for things like mortgage rates and taxes, and it bundles all those messy, unrecoverable costs into one simple, easy-to-use percentage. And using it is unbelievably simple. It's just 3 steps. You take the home price, multiply it by 0.081, and then divide that number by 12. That final number, in this case, $3,240, is the rent you need to beat. It's a simple way to get a clear, cold, hard mathematical answer. So what does this actually look like over the long haul? Well, check out this 10-year comparison. Now, the key here, and this is crucial, is that the renter takes the money they save each month and invests it. And after a decade, that discipline really pays off. We're talking over $155,000 in liquid wealth. The homeowner? Yeah, they have equity, but it's less, and it's trapped in the walls of their house. To get it, they have to sell and pay thousands in fees. The disciplined renter comes out over $60,000 rich. But look, the math is only one part of this whole thing. A home isn't just a number on a spreadsheet. It's where you live your life, your lifestyle, your career path, and, frankly, your tolerance for stress. All of that plays a massive role in this decision. These are the human factors, right? Flexibility is a huge one. If there's any chance you might move for a new job in the next 5 to 7 years, renting saves you from the massive headache and cost of selling a house. But on the flip side, the stability of owning, of putting down roots, that's a real valuable thing for a lot of families. You just have to weigh that against the fact that your wealth becomes illiquid. You can't just pay for a medical emergency with your home equity. And there's another factor we have to talk about: market risk. We've all been sold this idea that housing always goes up, but that can be a really dangerous myth. Housing bubbles are a very real thing, where prices just totally detach from reality and then, well, they come crashing back down. And this isn't just some theory. I mean, look at what happened in the US between 2006 and 2011. Prices fell by almost 40%. Can you imagine buying at the absolute peak and then just watching your life savings completely evaporate? This is a real risk of owning that renting completely avoids. So let's bring it to today. The 2026 market forecast shows something fascinating. Mortgage rates are staying high and home prices are still creeping up, but look at that last line. Rents are actually forecast to go down. That means the gap between the cost of buying and the cost of renting is getting even wider. The market itself seems to be telling us that renting is becoming a better and better deal. So, at the end of the day, there's no single right answer that fits everyone. The math gives you an incredibly powerful starting point, but the final decision has to line up with your personal finances, what's happening in your city, and where you see your life going. So, how do you actually make your choice? Well, it all comes down to asking yourself the right questions, now that you're armed with all the tools and data we've just walked through. This is it. This is your final checklist. First, your timeline. If you're staying for less than 10 years, the crazy high costs of buying and selling mean renting is almost always going to be the winner. Second, your values. Be really honest with yourself. What's more important, flexibility or stability? Third, do the math. Run the 8.1% rule for your own city. And finally, and this might be the most important question of all for a renter, are you disciplined enough to actually invest the money you save? Because that right there is the key to building wealth without owning a home. So the big takeaway here is this. You are no longer just a passive spectator in this decision. You've got the tools now. It's time to stop listening to all the outside pressure and start listening to what the numbers are telling you. So go ahead, run the 8.1% roll on a house in your neighborhood. What does the math say about your home?